You want to create a positive, consistent cash flow. So you want to have more money coming in your business than going out. What matters the most is what you keep.
Hey, welcome back to the show today. I have another special guest with me, Teresa Wagonseller. She is a CFO, and she's going to be sharing a lot of information around businesses and what she deals with. Teresa, welcome to the show.
Thank you, Brad. Thank you for having me. Glad to be here.
Well, first of all, what is a CFO? What does that even mean to someone who may never heard that term before?
Right. Good question. So CFO stands for Chief Financial Officer. They're one of the leaders or experts in most large corporations.
So typically you would see a CFO, multi-million-dollar corporation.
Yes.
And they're handling like financial strategies and how the money is kind of spent in the business. Is that correct?
Exactly correct. They handle all the money matters, all the financial strategies to align with the company's, goals, direction.
Gotcha. Yeah. So and some people may think like, oh, I have a bookkeeper. It's like, no, that's not what we're talking about here. We're talking about more from a strategic level.
That's correct.
Should I make this capital investment? Should we put money back to prepare for this, bad economy or whatever it might be? Like strategically, that's a lot of that's happening at the top level. Was that accurate?
That's correct. There's a big difference between, bookkeepers, accountants, or tax preparers, even CPAs. They mostly focus on recording the past, if you will, compliance work, for tax reporting, that sort of thing, which is very important,
Sure.
Obviously. However, the CFO is focused on going forward with the company. The CFO comes up with financial strategies to align with the company's, business goals. So it's more forward driven.
Oh, I like that. I've never heard it kind of broke out like that. So that makes a lot of sense then. Mm-hmm. And correct me if I'm wrong here, because I don't want to say something that's not true. You offer like fractional CFO services. Is that right?
Correct. So as opposed to large corporations that have in-house direct full-time, if you will, chief financial officers, most small companies or small businesses can't afford a full-time CFO, nor do they warrant one, to be honest. They're on a different level playing field, if you will. So what I'm offering is fractional CFO services at a fraction of the cost for the small businesses to make the CFO services more accessible and affordable to small business owners.
Yeah, and this is something that's come about in the last few years, like fractional services, right? So I actually just hired a fractional CMO a couple weeks ago, a chief marketing officer, right? And so I get access to someone who is an expert in their field. I don't have to have the payroll that comes along with that, right? I don't have to hire someone where I'm
That's correct.
paying them $100,000, $200,000 for their services. I'm only paying them basically, it's kind of a fancy way for like part-time, right? Like part-time position, if you will.
It is part-time, except I think my fractional CFO services are differentiated from the norm in that I have 25 years of experience in working with multi-million, billion-dollar corporations, as a CFO. And so basically what I did was I took the 25 years and I condensed it down into a system, like I said, that's affordable and accessible to small CFOs, but they're still getting the same level of service and comprehensive services that you would get as a large corporation. A large corporation would get from a full-time. A small business gets the same level of services on a smaller level, if you will. So there's strategic planning, and that kind of service isn't as high level or intense or, that you would encounter with a large corporation. So it's fitting, but they still get all of the same CFO services that they're getting from a full-time CFO.
Oh, absolutely. Yeah. Yeah. If I wanted to hire a full-time CFO, I probably couldn't afford you. You know what I mean? But if I only need you for, there's a difference between managing $100 million a year business and a $1 million a year business, right? There's just not that much moving parts. Like I don't need a full-time person. So makes perfect sense. Well, let's get into something that you talk about, which is what's the difference between a business that's a machine versus a business that's a job?
Yeah. So if you don't mind, I want to take just a step back for context purposes.
Yeah.
But one thing that drove me back to working with small business owners was There's a lot of statistics out there, and SBA or Small Business Association will tell you that 50% of most small businesses fail today within 5 years, that's crazy. That's 1 in 2 businesses that are out of the game by year 5. And 80% of those, it's due to lack of cash or they run out of money. So it's a cash flow issue for most small businesses. And so I've come up with the concept, if you will, of comparing a business to a machine or a money-making machine. Most people, most business owners go into business to make money. Obviously, that's first and foremost. And you have to have cash or money for your business to be successful. That's number one. And so I like to give the analogy, if you will, of a money-making machine, which is your business. So, for example, if you think of a washing machine, the purpose of a washing machine is to clean clothes, right? Mm-hmm. The washing machine has multiple parts and systems that run that machine automatically to clean clothes. It has a purpose. If one of those parts fail, the machine doesn't work, it doesn't produce clean clothes, and it's not operating like you want it to, right? So your business is kind of the same as a machine, except the purpose of your business is to make money. So the business as a machine also has moving parts, systems, and it's all about managing those parts of that money-making machine so that it does what it's supposed to do, which is to make money, generate money. You want to generate money out of your business from operations. And that's what the money-making machine concept is about.
Yeah, I mean that's making more profit. So I've done a little bit of research too, and I talk a lot, and specifically in the contracting space, the statistics said that within 10 years, 96% of contractors go out of business. So that's even a higher, right, staggering statistic. And it's from what I've found working with contractors, it is definitely usually money, but the second thing is burnout. So they may be making okay money, but they're working 80 hours a week in order to achieve that level of money, right? So it's not sustainable over a long period of time. And so I think a lot of people, and especially my listeners, will say like, yeah, nobody wants to work 80 hours a week. Like we want to have a machine that's producing money and all that. And I totally understand the machine concept. Like, we use power tools and machines every day, so we totally can relate to that. But what are we doing wrong then? Like, how do we turn our job into a machine?
Okay, so that's a great question. I think I like to keep things simple.
Me too.
And I think first and foremost, businesses are, while they're focused on profits, and while yes, profits are important, I think the number one most important item to focus on is cash. Cash is king. We always hear cash is king. And I've even heard it said cash is king and there ain't no queen. And that's exactly right. When you focus on cash and cash flow, inadvertently, you're also focused on profits and revenue. And I say that because profits and revenue are part of cash flow focus. So they're part of the equation of focusing on cash flow. So you're focusing on all three. However, being done wrong or the wrong thought process is businesses can stay in business as long as they have cash. Even if they have losses, they can have negative profits, losses, and still stay in business as long as they have cash. Cash is the bloodline of the company. However, they cannot stay in business if they don't have cash or run out of cash. They can have profits. You can have profits, but have no cash, and you will go out of business. So the focus has to be on cash flow first. And I'll give you an example of that. Think about Amazon. Amazon had losses the first 5, 6, 7 years in business. They sustained and stayed in operations because they had cash. So if you have cash, then you can stay in business. So I think that's the number one concept or, thought process that is missing with most business owners.
So it sounds like one of the first things that we need to do is build up a cash reserve in order to help with any drop off in revenue.
Yes. The way I would word it or state it is you want to create a positive, consistent cash flow. So you want to have more money coming in your business than going out. Okay. And That's what's key. And once you start generating that cash flow from the operations of your business, then it's a matter of, what matters the most is what you keep.
Mm-hmm.
And what that means is, you have to manage all the other parts, the spending, the cost factors, all of that, and so it's what you keep that matters. And yes, to your point, ultimately you will build up some cash reserves or excess cash, positive cash flow. And then there's so much you can do with that, that cash, obviously. I mean, any problem you have in your business can be resolved with cash. If you think about it, if you have a marketing issue, you need to spend more money on marketing, or you need to hire another manager, or, whatever the problem is in your business can usually be resolved with cash. And then, also you build up those cash reserves or build up that excess cash or positive cash flow. And you can do more things with your business. You can put the money back into your business. You can grow your business. You can take the money out if you want, use it for, personal retirement, college funding, whatever the owner wants to use it for. And you can also get some freedom out of your business with, cash by hiring some people to manage some other areas in your company to give you a break or a relief from the business, because most small business owners wear all the hats in the business, right? And they can't ever, like you said, they're working 80 hours a week and not making any headway. So there's a lot you can do with cash. But I think, yes, it's important to focus on the cash flow first and foremost.
So, so how do we, I mean, I think everyone understands that you need to make more money than what you spend. I mean, in the concept of it, I think most people would understand that. How do we increase the cash flow then? Like, how do we get our business set up so that we are cash flow rich?
Yes.
The high level ways of doing it. Obviously, there's all kinds of specific ways, but let's kind of like keep it high. What's some ways that we can set our business up to do that?
Right. So this is where I talk about the money-making machine. And this machine has 16 specific parts to it. All 16 parts contribute to cash flow. It encompasses what I like to call three buckets, if you will. You have a revenue bucket that has 5 parts. You have a profit bucket that has 5 parts. And then you have a cash flow bucket that has 6 parts to it. And all of these parts are focused on increasing revenue, profit, and cash flow. And they're the drivers of your business, if you will. So the 5 parts that drive revenue, for example, are your leads, conversion rate, your retention rate, your number of sales transactions, volume, and then the average sales price. Those are the 5 drivers of your business that drive the revenue. And then the profit bucket has 5 drivers as well. These are all the machine parts that I was referring to. Mm-hmm. And so the 5 drivers of profit are going to be your cost of goods sold, mm-hmm. The money it takes to generate those sales, and then your labor cost or payroll, marketing cost, and overhead. And then you have other expenses and income that are not operational type. So those are the drivers that drive the profits of your business. There's 6 drivers of cash flow. Now, these cash flow drivers are where most small business owners aren't aware of, I guess I should say. Okay. Influx and outflow, or inflow and outflow of your cash, that's hard for most small business owners to understand. And there are things that you don't see on your income statement. Like, you don't see them in the profits of your income statement or the revenue side of your income statement. And there are things like, number 1 is, days sales outstanding. How many days does it take for you to convert sales to cash? You don't see that on your income statement. Mm-hmm. Number 2, inventory days outstanding. How many days does it take to convert inventory to cash? You don't see that on your income statement. And then number 3 is your accounts payable days outstanding. In other words, how many days does it take you to pay most of your vendors? Most of us have 30-day terms or whatever. You don't see that on the income statement. Number 4, your purchase and sales of equipment or assets. When you purchase a piece of equipment, that's cash out the door. When you sell a piece of equipment, that's cash in the door. That you don't see that on the income statement. And then you have number 5, I think I'm on number 5, is debt service. So you take out a loan, you borrow funds, you get cash in the door. You pay or service that debt, that's cash out the door. That's not on the income statement. And then the last one is owner investments or draws, distributions, like owner putting money in or taking money out. So none of those are you see in the income statement or in the operations of the business, but they affect your cash flow. So when we go back to saying, you want more cash coming in versus cash going out, it encompasses all of those 16 parts.
Yeah, there's obviously a lot to that. I tell you, the one thing that got me all the time was accounts payable. And
Yes.
specifically, I had credit accounts with all the big box stores and local hardware stores and all that. And, they're on 30-day cycles. And so I go spend $10,000 in material, I do the job, and then it's like I get paid and, like, oh, I got a bunch of money. Well, no, 25 days from now, I'm going to get a bill from there for $10,000. And,
Right.
so this happened more with like the what do they call it? Checking balance accounting or whatever the term is, where you just look at the bank and see how much money you got. Oh, I got $30,000. Like, no, you actually only have about 12 in there.
Exactly.
Yeah. So any thoughts on that?
Well, right. I think, especially in this industry, construction. I've had a few construction industry related clients accounts, and the biggest problem I saw is exactly right. They bid a job or do an estimate on a job, and let's say it's $5,000, and the customer agrees to that $5,000. Great. So they get started on the project, and they put $3,000 out there to get their labor, to pay for their labor, materials, supplies. They put $3,000 out to begin with to start the project, right? And then they complete the project and they're thinking, great, I just made a $2,000 profit. Right. You did make a $2,000 profit. However, the customer pays in 90 days.
Mm-hmm.
You don't have that $5,000 from that customer yet, but you put $3,000 out. So that you have a negative cash flow of $3,000, that came out of your bank balance, right?
Yeah.
And what if the customer never pays? And if you take that one job estimate, that one job, and say you've got 40 of those in the works, like that, you've got a huge, multiply that times 40, you've got a huge negative, cash flow. Which is,
go ahead. I'm sorry.
No, that's okay. I'm just saying that's detrimental. And that's what happens a lot of times, in these businesses that, where the business owners don't understand the concept of cash flow.
Well, absolutely. I agree 100%. When I first got started, I did a lot of handyman jobs because it was what I could afford to get started, and eventually started doing more remodeling. But it wouldn't be unnormal. I guess that's the right word. I can't even think. But it would be normal for me to have 15, 20 invoices out at a time that weren't paid. And we did a lot of work for national facility maintenance companies. And these are, companies that have national accounts at Target or whatever. And they would call us and be like, hey, can you go over to Target and, unplug a toilet or whatever, or fix a piece of trim that fell off, right? And so we would get those work orders, but they would have 30, 60, 90, 120-day payment terms, and I remember this, looking at my books one time, and usually QuickBooks will like scream at you and like say, hey, this client has a credit, or this, it's like, what's going on here? So finally I look at this, red flag that's going on, and I had an account that it was only like, I don't know, $200 or $300. It wasn't a lot. It wasn't like hurting my business, but I literally didn't get paid on that for a year. It was 12 months before I got paid on it. And it was because I didn't follow up with them to make sure they paid me. I just forgot about that.
Exactly.
Right. They, something slipped through the cracks on their end. And so they didn't get the email or they didn't pay. And I reached out to them and they paid me. But it was 12 months later, but that was my fault because I wasn't on top of the finances and making sure the accounts receivables were being paid.
You're exactly right. And a lot of small business owners, like I said before, because they're wearing all the hats of the business, they spend all day, putting out fires, working in the day-to-day operations and in the weeds of the things of the business, if you will. And so they're not looking at it from a bird's eye view, and they don't have time. Like they have this huge past due receivable balance, right? That's all money that you haven't received yet. In other words, you're the bank for those customers.
Yeah,
You know,
absolutely.
and that's extremely, harmful to your business. So you have to definitely have somebody that has the time to manage those receivables. Or one thing what I like to do with businesses that I've found successful is in this line of industry, when you do your estimate, I think there's two critical things that need to be on that estimate. Obviously, first and foremost, the estimate needs to be as accurate as possible. We all know that because you can't, it's hard to
Yeah.
recoup, misestimated cost, as you're going along with the project. But two important things I think are critical on an estimate is the first one is you need to have margin of error, margin of safety, built into that estimate.
Yes.
Thing is you need to have payment terms for your customers that they agree to. And I like to use phase billing,
Mm-hmm.
um, which basically means, the customer pays you a third upfront, a third of the total cost upfront, to get started. And you invoice them that at the beginning of the project. They pay that before you even start. And then 2/3 into the project, they pay you invoice, you pay the next third. And then the final third is paid at the end of the project. And in doing that, you align your cash in with the cash going out so that you don't have this huge negative cash flow, going on in your business, if that makes sense.
Absolutely. And I mean, you probably haven't seen it, but one my most popular video on TikTok is I have over 1 million views on it. It's actually about cash flow. So like this is one of the reasons why I
Mm-hmm.
want to have you on as a guest, because this is an important part of construction. And my belief, and I'd like to get your thoughts on it too, is that really the customer should be paying in advance for every portion of the job. And if you do that, then you will have $0 out of pocket to complete that job.
That's correct. And you can generate a
Yeah.
positive cash flow in doing that if you have vendor terms. So, in other words, if your customer is paying you at the beginning of each phase of your business and you're purchasing materials or supplies from your vendors as you go along, but you have a 30-day payment term with them, then you've got a positive cash flow there of 30 days. That's an ideal
Yeah.
situation.
And just to be more specific, like when I was doing remodel, my payment terms were 40, 30, 20, 10. So I required a 40% deposit. And some people are like, I'm never going to pay you, I'm never going to pay anything until the job's done. I'm not going to work with you then. That's okay. You don't have to. But for
There you
me,
go.
it's 40% down. And with that 40%, I can order all the materials that I need. I can cover all of the pre-construction permits, planning,
Mhm.
overhead labor, and even some of the initial getting started labor. And then I have I think, well, I forget your term, but we call it milestones, like milestone payments
Mhm.
at this certain
Mhm.
milestone. I think you call it phases.
Right?
Um, at certain phases, then we're going to collect 30%, and then we're going to collect 20%, and then the final payment is 10%. And on the back end of this, and I'd like to hear your thoughts on this too. The reason why I always made the last payment 10% was because that's pure profit in my business for that job. And if for some reason the customer goes south and they're like, I'm not going to pay you, I'm going to dangle this over you to come back and do a bunch of free stuff, I have the ability to walk away from the job and not like be owing my vendors, $20,000 because they're holding 50% of the final payment. What's your thoughts on that? Hey, just a quick time out from the show. If you're a frustrated contractor who's dealing with low profit margins, stuck working on the tools every day, or doing free estimates for people who are never going to hire you in the first place, I invite you to my private contractor community, the Profit Club, where contractors just like you are adding 2 to 3 times more profit each year without producing any more jobs and finally getting completely off the tools to never do another free estimate again. So if you're ready to increase your profits, stop doing free estimates and get off the tools, then all you have to do is click the link in the show notes to learn more about the Profit Club and see how it can easily 2 to 3 times the cash in your pocket, give you a proven sales process that will convert more jobs with ease and get you off the tools once and for all. And the best part is you can do all of this without having to produce more jobs than you currently are. Click the link to learn more. Now let's get back to the show.
That's correct. Yeah, you're not upside down. So basically what you did was break even, right?
Well, hopefully you'd make
I
more than
mean, worst case
10%, but
scenario.
yes. Yeah. I'm not
Right.
losing money. At the very minimal, I'm breaking even. I'm not losing money.
That's right.
Well, I was going to share a nightmare story with one of my
Oh, yeah, yeah.
clients. I'm not going to say who it is, but he's a remodeler, and he was doing a project, and he didn't have his payment terms set up like the correct way. And there was a problem with some cabinets, and the customer was like, these aren't the cabinets in the showroom. What happened was the showroom had an old finish that they don't make anymore, and the
Mm,
substitute wasn't the same, and they weren't happy with it. The showroom should have taken down that cabinet, display, and that's
mm-hmm,
what they wanted. And so this whole thing turned into a major thing, and the client's like, I'm not paying you the next milestone until the cabinets are finished. Okay, well, the company had to make the cabinets. They came in, they were wrong. They had to remake them. They came in, there were still problems. This is going on for like 2 months, and the client's sitting on almost $93,000 of the contractor's money, and it almost bankrupted his business because of that scenario where the payment terms weren't set up in the
mm-hmm.
contractor's favor.
It's exactly right. That's why cash flow is so critical. You just made the point. Without it, you'll go out of business. And ideally, what you want to do is, hopefully, there's this thing of having all your eggs in one basket. Obviously, that was a huge, job or project. But hopefully you don't have too many of those. The other thing you can do, if a business is healthy, financially healthy, in this industry, is get a line of credit.
Mm-hmm.
If you can get a line of credit, that kind of eases the cash flow, especially when you get in a situation like this where you can draw down on that line, to help fund your timing difference there with the cash. And then, of course, when you collect or when you get over that huge speed bump, then you can pay it back. Not every business has access to line of credits, but that's obviously a good backup backup plan for cash. Because you can get cash from three sources, and that's debt, by borrowing, or some people use credit cards, which isn't advised. But borrowing funds, the second way is you can owner investments, whether it's the business owners own savings that they put into the company, or they get outside investors that come in. The only hesitation there is you're diluting your
Mm-hmm.
business, the ownership of your business. And then the third way, and the best way, is obviously to generate the cash through the operations of your business. And so I think, to your point, you have to consider all of that and the what ifs. And if you can focus on building your positive, consistent positive cash flow, so that if you get in a situation like that, you're okay. You've got enough reserves there, or excess cash, positive cash flow coming in from other projects, that'll cover it. That's the situation you want to be in. That's why cash is so important.
Well, this is also the point of where people get in a lot of trouble robbing Peter, pay Paul, right?
That's
They
right.
sell jobs to collect that deposit
Yes.
because they need to pay off the last three jobs materials. And
Yes.
so one of the things that kind of, it wasn't hard, but like when I realized it, I was like, oh, that makes sense. But like, you may have cash in your bank account, but it's not really your cash, in the sense of money's always flowing. And so at any given time in your business, there may be 10, 20, $30,000 that's just constantly exchanging hands, and you
Mm-hmm.
really can't use that money. Like, it's just a placeholder for the next bill that you're waiting on, or it's a placeholder for the bill you have to pay.
Mm-hmm.
Just this idea of like, you have to have extra money to use to cover these ebbs and flows of accounts payable, accounts receivable cycles.
That's correct. I think, it's important for business owners to understand, that they can't simply just go look at their bank balance.
Mm-hmm.
And if it's positive, they're like, okay, great, we're good to go, and off to work they go, putting out fires and doing whatever. So there's a financial statement that's called statement of cash flows. And what that measures is, it measures how much cash you really have. At the end of the day, after all of the cash flow drivers are taken care of. So in other words, it accounts for all of those machine parts or drivers that I just mentioned that you don't see through the operations of your business. If you're thinking just on a profit level,
Yep.
it's not, revenues minus expenses gives you your profit, right? But then there's other things you have to pay for out of that. You have to pay for, taxes, debt service, and the days that we talked about, how long it takes to collect money from your customers. And if you don't collect it, that's lost money. That's lost money you'll never get. How long it takes if you have any kind of inventory to turn that inventory into cash. All of those are factors that, like you said, are pulling and going against, coming and going in your cash flow that you have to keep tabs on. And I think most small business owners don't know how to monitor those, manage those. They could be difficult, for the small business owner to manage those.
Well, I mean, let's be real here for a second. I mean, Americans in general are terrible at cash flow, and I mean, on a personal level, like they don't,
Yeah.
once we got rid of the checkbooks, where you had to, balance your
Yeah.
checking account, right? Showing
Right.
my age a little bit, but once we got rid of that and it was all on a debit card or credit card, like on a personal
Makes it
level,
even more
yeah, we
tricky.
don't know how to manage our cash flow.
Mm-hmm.
And then you add
Mm-hmm.
in all of these complex layers that go into a business, and it's easy to see why a lot of guys. I always joke a lot and I talk a lot about, if I go to Lowe's and I see a brand new, construction company that I've never heard or seen before, and the guy's driving, like a brand new F-350 pickup truck, I'm like, oh, that guy's going to be out of business probably in the next 6 months. Because
Yeah.
what do? They have a little bit of
Well,
success and they
right.
instantly raise their lifestyle to try and show off, right?
Yeah, and you just told the life story of my daughter, one of my daughters.
Oh, sorry.
Is no, she's very proprietary mindset in doing businesses, but she doesn't, the cash or money matters is not, her. And I've learned that's most small business owners are like most small business owners go into business because they're good at a craft
Hmm.
or, I mean, they have a marketable skill or a product, right? And that's why they go into business. And then, but obviously you want your business to make money, but they're not the numbers people. They don't look at, most of my clients don't even look at their financial statements,
Yeah.
so they look at their bank balance, like I said, and that's it. And if they got money in the bank, they're good to go. And then again, a lot of them are, sweating it out or they have trouble sleeping at night because they're worried about making next payroll,
Yeah.
and or they're making profits, they're making money, but where is all the money? Where did it go? It's not in my bank account. Where did it go? And so it can be stressful, very stressful.
Absolutely. I have coined a term. A lot of guys use Santa Claus accounting, and that is where they get to the end of the year and they're hoping that Santa Claus brought them profit, right?
Right.
Like you can't do that.
Yeah. Or put money in their bank account.
Well, they're waiting until the end of the year to see how much money they made, to see how much profit they made,
Yeah.
because they're not tracking this, throughout the year. To your point.
That's exactly right. So, like these 16 moving parts that I was talking about, you have to, first of all, they're all the parts of your machine. You have to make sure they're all working right. They're all, you monitor them, and if one's not working right, you got to dive in and find out which part's not working, tweak that part, and fix that part. So your money making machine keeps making money, it keeps working. And if you can keep all the parts working like they're supposed to, which involves monitoring and measuring and tracking. I mean, there's a lot involved
Hmm.
in it. But if you can do that on a consistent basis so that you're generating consistent cash flow, it helps you get that going and that momentum going. It takes you out of the day-to-day operations of your business. It gives you some freedom, because you've got these moving parts working and you're not killing yourself in trying to manage all of that. That's the main reason why most companies have a financial matters person handling that for them.
Well, it makes perfect sense. Not
Yes.
a CFO, but when I hired my bookkeeper, She was a CPA / bookkeeper, but she followed, I don't know if you're a fan of profit first accounting or not, but that was
Mm-hmm.
her thing. And so she basically helped me set that up in my business. And when
Mm-hmm.
she took over, that was the best investment I ever made because I no longer had to worry about any of that stuff.
Mm-hmm.
And I was getting
A
reports.
huge
Oh my
relief.
gosh, it
Yes.
was. But that's kind of more bookkeeping stuff. If we're looking at CFO stuff, like you said, it's more future forward thinking, it's more strategic.
Yes.
So what would be a typical, if someone were to hire you for their small business, like what would be a typical outcome, I guess, that they would try to achieve? Or like what would you help them? What does that look like?
Right. So that's a great question. So the way I like to work it, or my process is, I like to meet with the business owner, for about 20 minutes. And I call it more of a right fit meeting or call. I want to talk to them and make sure we're a good fit for each other. First of all, tell me a little bit about your business, which entails what your challenges are, what your goals are. I think first and foremost, what there is, every business owner has personal and business goals, right?
Mm-hmm.
And what are you trying to achieve? Why did you go into business? What are you wanting out of this business? And then tell me what your, a few challenges are. And then I usually offer a financial assessment. I'll do a financial assessment on their business. No cost, no charge, because I have learned it's much better for me to show the business owner how I can help them as opposed to telling them how I can help them. And so I'll do a financial assessment on their business. And what I'm looking for, any red flags, any opportunities, I analyze the strengths and weaknesses of their business. And then I come back and based on their personal and business goals that they told me about, I show them a strategic plan, of how we can get there. So for example, just give you an example, say a business owner they're wanting to, they maybe they want to grow their business and they want to be at this level, take it to the next level within the next 5 years. Or maybe they want to sell their business. To sell a business, you want top dollar for it. If you want to sell a business, obviously, and usually that's a multiple of cash. So, for example, if you have $100,000 in your bank account and you want to sell it, it usually sells on average 2 to 4 times whatever you have in the bank. So you might get 2 to 400,000, on the sale of that business. But if their goal is to maximize their, payout on the sale of their business, then that is the strategy that I come up with. And then I meet with them, once every month. We have a meeting once every month, and I go through a 6-step process with them on a monthly basis to make sure we stay on track to hit those targets, those goals. And that usually looks like, first thing we do is obviously create the targets based on those goals. And then I take their actual numbers or their financials and do an assessment on it. I do a forecast as to where I think they're going to be at some point in the future, 6 months, a year from now, whatever it is. And from there, I compare basically the forecast with our target, the goals we're trying to hit, and come up with a scorecard. So it's like a dashboard, a scorecard, and that's what I present to the clients. So the clients never have to look at financials. Financials are not made for, they're made for the accountants and the tax preparers. They're not management reports for small business owners.
Right.
So I show them a simple scorecard of here's where we're hitting our targets and here's where we're not. And those are the 16 drivers that I was talking about earlier, the 16 parts of your machine. So we track and measure those. And here's where we're hitting, here's where we're not. I take the top 3. You may have 10 drivers that we're missing on, but I'm going to take the top 3 and we're going to focus on those because they're going to have the largest impact on, your business if we focus on these 3. And then we come up with an action plan. We come up with an action plan that we execute for the next 30 days. And we focus on these 3 drivers to improve, your business. And then we meet again at the end of the month, the next month, and we go through that same process again and see, did we improve or where are we hitting it and where are we missing it? And then we realign again, new action plan, and basically just measure and monitor those metrics to make sure that we're on track, to hit those targets. And If we're not, then I provide corrective, actions each month to help these owners stay on track.
Gotcha. And that could be anything from like, hey, you need to collect these accounts receivables, you need to raise your prices, you need to cut your overhead. I mean, whatever it is, like you're giving them action steps on what's going to have the biggest impact in their business.
Exactly. That's exactly right. Yes. So, and I think a lot of business owners too, I think they think, if they're running short on money or, the business isn't doing as good, they tend to go straight to sales. I got to increase sales, you know, and that's not always the issue. You could have great sales, like a lot of businesses do have great sales, but a lot of times the problem is the margin, the gross margin,
Mm-hmm.
and which is which drives your profit, right? And affects your cash, your cash flow. But so a lot of times it's tweaking that cost of sale or that labor cost or, whatever it is to get your gross margin, improve your gross margin. So, I mean, it's not always sales oriented. There's 16 other parts,
Yeah.
to the machine that, yeah.
Well, yeah. I mean,
And it's usually,
go ahead.
yeah, it's usually a combination of them. It's not just one part that's failing. It's usually a combination.
And that's the benefit of hiring an expert like you, because you know all of those, and I may see like, oh, this one part of my business is not doing well, so I need to increase it. But what I may not recognize is that this other part here, actually may be causing more problems, or it may,
That's right.
so having an expert like you that can look at it and say, here's all the financial side of the business that we need to look at and monitor and make sure that we're paying attention to that on a regular basis. There was a quote that somebody told me one time. I'm not going to say it exactly because it's got profanity in it, but his philosophy was, don't F with the money. Like, just anything that has to do with money, sending out invoices, collecting it, just you don't neglect that. Like, you don't F with the
That's
money.
right.
You don't mess with the money. All right.
I actually have a blog that's labeled, ignoring your business financials or finances is insanity.
It is.
The definition of insanity. And it's because it's amazing to me how many business owners and rightfully so, they don't understand what they're looking at, and I like part of what I do as a CFO as well is to try to help educate in simple terms, give the business owner an understanding of those financials in simple terms. So they understand what's going on in their business. So I can take the financials, I can read the story. Every set of financials tell a story.
Yep.
And I can immediately read the story and tell you what's going on in your business. And then just, through these 16 drivers or whatever, I can illustrate with them, like I said, with a scorecard. So they can easily see, which drivers are working, which ones are not, which levers to pull, in the business, and which ones are going to have the biggest impact. So I can explain that to them and show it to them. And what's exciting to see is whenever they execute, these action plans and they do it, we get 3 months down the road and they see a big difference. Their cash balance has gone up, their profits have improved, whatever it is. And it's exciting to me.
Oh,
I mean,
yeah.
that's the main reason why I've come back to working with small businesses.
Yeah, I mean, you have a much greater impact on a small business from a personal level than you do working for a corporation, millions of
Yes,
dollars. So
yes,
you're affecting
yes.
people's lives. Like,
Exactly.
you're
Exactly.
giving them this advice, they execute on it, and then as a result, they increase their lifestyle and their family and kids and generational wealth and all that
Yes.
stuff. It's not some corporate that's going to buy a new jet with it, kind of
Right.
stuff.
That's very fulfilling to me.
Absolutely.
I'll be honest with you, that's what I miss the most in the corporate world. And that's one reason I've decided to recently I've stepped out, a while back and going back to what was exciting,
Yeah,
thrilling, so yeah.
absolutely. Well, lots of great stuff on here that we talked about, Teresa. I really appreciate it. I like to ask everybody, all my guests, a question, and that is, what's a book that you are currently reading or one that you recommend?
One that I currently have the most connection with that I really appreciate is I think it's Alan Carr's Mindfulness.
Mm-hmm.
Easy way to mindfulness. I can't think of the exact title, but I love that book. I've read it a few times. I've cornered pages. I go back to certain pages just to remind myself,
Yeah. Yeah.
I think that's a great book.
I think it's the same. I've read one titled Mindfulness. I don't remember the author. It's probably the same one that you're talking
Hmm.
about. So yeah,
Hmm. Excellent.
anything has to do with mastering your mindset is always going to be a positive with me.
That's exactly right.
Awesome. Well, if I appreciate you being on the show, Teresa. If someone wants to reach out and learn more about your services that you offer, what's the
Hmm.
best way to do that?
Right. So I have a website. It's higher up CFOservices.com. And that's higher as in, rising or increasing, higher profits or higher cash flow.
Amen.
And I do want to mention as well, if you want a list of the 16 drivers, that I spoke about for revenue and profit and cash flow, I have them listed on my website. There's a resource page on my website that has those listed. There's also a quick little 10-page slideshow of the 6-step process that I use with my clients, every month to help them monitor and track, watch these drivers like a hawk is how I like to say
Love it.
it, to keep your business moving forward. So that's on there as well.
Awesome. We'll put links to the show notes too. That way that people can go to the show notes if they're on Spotify or
Okay.
whatever and just click on it.
Yeah, and if they want to book a call, like I said, it's free, no charge. I love talking to business owners. So even if you just want to book a call and talk about your business, I think that's great.
Awesome. Well, I appreciate you doing that for our listeners and for hanging out with us today.
All right. Thank you, Brad. Appreciate it. I had fun.
Perfect. Well, guys, that's the end of the episode. You know where to find me. You can just search on the social medias for the Hammer and Grind podcast. You can also go to the show notes and get links to all those, including my latest book that I wrote, The Contractor Profit Blueprint. I think Teresa would appreciate that name. And and as always, guys, until next time, remember, profit is not a dirty word.